Been a pretty rough couple of weeks for interest rates. In fact, it's not been a great month for interest rates. We're going to get into the numbers in today's video, so stay tuned. Let's get right into the numbers. Mortgage News Daily has the 30-year average fixed rate conforming loan at 7.29% today. That is up about an eighth of a point from this time last week, where we were at 7.17%. Last Thursday. 30 days ago, we were at 7.41. So we're down a little bit from the highs that we hit earlier in the month of May, but still quite a bit higher than we were a week ago, y'all. And here's what has been hurting interest rates. The government's spending too much money. They have had to float a significant amount of debt instruments onto the marketplace to fund those deficit shortfalls. And the quantity of that debt is not being well received by the marketplace. So we see 2, 5, and 7 year auctions this last week that were very weakly attended. We did not see investors snapping up those bonds at the rate that the market would like. And we are seeing, as a result, those prices come down and those yields go up, and those yields are very much our rates. So the bottom line is, when you spend more money than you take in, you've got to issue debt. You have to borrow money in order to cover the difference. When the market doesn't want to buy all of that debt, all you can do is make it cheaper and pay a higher yield or a higher rate of return on it. That pushes our interest rates higher, and that's what we're seeing happen as a result of this. If you look, though, y'all, even with this bit of a bump that we've seen in rates over the last 30 days or so, we're sitting kind of right at the lower end of where we've been over the last 12 months. If you look at a 52-week range for interest rates, we've been as low as 6.61 and as high as 8.03. So we're kind of on the lower end of that scale of where we've been over the last 12 months, owing to the fact that the market is bracing at some point for the Fed to begin cutting. We saw a little bit of reprieve this morning when we got first quarter revisions to the gross domestic product for Q1. That reported in initially at 1.6%. This is now the second revision of that report, bringing it down to 1.3%. So we have much slower growth in Q1 than was previously reported. With these revisions, that sign of economic weakness has actually helped the bond market some. That has helped interest rates, and it stopped the bleeding from these weak note auctions that we had going earlier in the week. Let's revisit, though, what the expectations are for a Fed cut. Because really, until we see the Fed move to ease their current positioning, we're not going to see a real significant move in rates. There is a 0% chance. This is, again, CME FedWatch tool that I'm using. This is CMEgroup.com that publishes this. You can go to that website and they will show you, and you can project out. They have a number of tabs you can click on for each of the coming months, or each of the next 5 or so Fed meetings. In fact, they go through 2025 with expectations of where the Fed might be. Of course, the closer you get to those dates, the more accurate that information is going to be. But here's where they are for the next five Fed meetings. 0% chance of a Fed cut is anticipated for June. I don't think anybody's expecting the Fed to move, with all of the public statements saying that they need to see more movement in inflation reductions or softening in the labor market. Either of those moving significantly may change that equation a bit. There's a 12% chance of a cut at the Fed meeting in July. There's a 50% chance of a Fed cut in the meeting in September. There's a 63% cut at the November meeting and an 82% chance of a cut at the December meeting. So we see, as we go deeper in the year, the expectation that the Fed is going to be more accommodative in their current tightening trend. So, y'all, we may see a bump later in the year in housing activity. I think we all agree we've gotten off to a slower start than we had hoped to this year, owing to these stubborn inflation numbers that have kept interest rates high. In any event, I hope this information is helpful. It gives you something to share with your clients as you're preparing them to move into the marketplace. As we have said repeatedly, don't let interest rates be a reason to not grab the house that you want. We are seeing softening in the market. We're seeing significant concessions being built into the marketplace. Grab those while you can, get the house that you love, and then when rates do moderate down the road, refinancing is a thing. We're happy to take care of it for you. In fact, with our rate reset program, we cover your lender closing costs on that refi if you used us for the purchase. So call me for details on that. Happy to share. As always, I hope this is helpful for you and for your clients. You can reach me as always. All of my contact information is on the screen. Stay blessed, stay safe. We will talk to you next week.